Hello, everybody. Eddie Denny here. Thanks for joining me today. As many of you do on a weekly basis, I really appreciate the nice turnout we get. Lots to talk about, of course. Thank you. For some of you sent me some well wishes on recovering from this retina procedure. For 7 days, I had to kind of basically stare down at my feet. And I wasn't the best of patients. I'd say 70% of the time I was able to do that. So I was kind of wondering whether I just had screwed it all up, but apparently it went well. And right now, the left eye is fine as it was before. And the right eye is kind of like being in a swimming pool or staring at an aquarium, but there's a little gas bubble that's supposed to dissipate over time. So I think I'll be back to normal here within the next week or so, all things considered. Well, I hope you're all well, and that as we look at the next week or two, things will go well for us. We've had a heck of a good rally here since October 12th, and there's a lot of pessimism and concern about the sustainability of that rally. This morning's briefing is titled A Pandemic of Pessimism, otherwise known as the Wall of Worry. The stock market's done a great job of climbing a wall of worry. I think you could just as well call it a pandemic of pessimism. The reason I like that term is it focuses on the fact that this time has been different. Some really unusual things happened, particularly the pandemic. And I think there's still lots of shocks and shock waves emanating from that pandemic that are having an impact on the economy. And I know macroeconomists like to have models and are wondering why their models aren't working, or they're tweaking them to say they're working after all. But I don't know that you can really model a pandemic and its impact on the economy. So you have to be fairly empirical about that event and its impact on the economy, is what I've tried to be. Now, with regards to the pandemic issue and the impacts had on pessimism, it's clearly created lots of pessimism about a recession. I think there's been talk about a recession really since early last year when the Fed first started raising interest rates. And for a while there, it was going to happen in the summer of 2022. Then it was going to happen before the end of 2022. Then at the end of 2022, it was widely perceived that it would occur in the first half of the year, and then we would see that in earnings reports for the first quarter, which were just released, and that those earnings reports would be terrible, confirming a recession. The stock market would take a dive on that. Well, that didn't work out, so the pessimists are pushing it out a little bit further. So let's look at the third and the fourth quarters. If in fact it happens in the third and fourth quarters, then the one person who clearly got it right in terms of being vocal about it would be Jamie Dimon, because Jamie Dimon said in the summer of last year that everything looked pretty good to him, but he was worrying about a hurricane in the second half of this year. And the reason for that is he figured that the only thing keeping the economy going and growing was excess savings, and that that excess savings would be depleted by the second half of this year, and then we'd get a consumer recession. So that's a plausible scenario. It's in the realm of possibilities. But as I've been pointing out of late, it's kind of hard to have a recession when employment just keeps rising to new record highs to the tune of a couple of 100,000 a month. It's hard to have a consumer-led recession when wages are increasing faster than prices, as has been occurring over the past few months. So I think the consumer still has the purchasing power, the wherewithal to keep the economy growing. And on top of all that, let's not forget that the government has provided all sorts of direct cash spending as well as incentives to onshore things like factories of semiconductor chips. And of course, companies have a tremendous incentive to onshore given the increasing geopolitical tensions that we see around the world, particularly between the United States and China. So those are at least two areas where there's a lot of strength. And that explains a lot. It explains why construction employment is at an all-time record high. in an environment where construction is in a recession, not across the board. It's in a recession in single family. Multifamily is still quite strong, though that may start to weaken if some of these regional banks cut back on their lending to those kind of projects. But all in all, we've had a rolling recession. It's rolled through the single family housing industry, and yet it hasn't had an impact on overall employment in the construction industry. I think we can say the same kind of thing about truck transportation. Truck transportation employment, all-time record high. How could that be when we know that there's been a recession among goods producers and providers being retailers? And we know that sometime early last year, the retailers double ordered from China and other places because business had been so good for them during 2021. And by the time all these goods got through the ports of LA, consumers had basically been satiated with their pent-up demand for goods and then some, and pivoted to services. So we have had a recession in the retailing industry with a big pileup of inventories in the second half of last year. And one of the reasons that real GDP was up only 1.1% in the first quarter is because there wasn't any significant inventory accumulation in the first quarter as retailers and others worked down their excess inventories through price discounting and simply by not ordering again. So we saw that in orders. We saw that in the manufacturing purchasing managers index, and yet truck transportation all-time record high. Go figure. So what I'm saying is we have plenty of evidence of a rolling recession. We don't have a lot of evidence that it's becoming an economy-wide recession. And meanwhile, the employment indicators still look pretty good. For tomorrow, I'm writing more on this notion, and I've written about it before, that payroll employment is one of the four components of the index of coincident economic indicators. That's really the monthly data that's available to give us an assessment of whether the economy is growing or falling into recession. The year-over-year percent change in the CEI is highly correlated with the quarterly data on real GDP, and it's available on a more timely basis. And I would say of the four components of the CEI, the most important one is payroll employment. Why? Well, we get it first thing at the beginning of the month. So it's the first of the four that are available. The other four are personal income excluding transfer payments. They are real manufacturing and trade sales. By the way, it's real personal income excluding transfer payments. It's real manufacturing and trade sales, and it's industrial production. So if we know that that employment is strong, we can also calculate what we call our earned income proxy, which is payroll employment times the number of hours worked during the week. So that gives you aggregate hours worked. And then we multiply that by average hourly earnings, which is wages. And that really correlates extremely well. It's a great indicator for the wages and salaries component, private wages and salaries component of personal income. So it was up by 0.7%. The EIP was up by 0.7% in April. That gives you a pretty good clue that wages and salaries and personal income were up significantly. And if that's the case, then here we've got two of the four coincident indicators looking like they're going to be going to record highs yet again. What about manufacturing and trade sales? Well, the one data point in that series that we will have before the coincident indicator comes out is retail sales. And the retail sales number correlates real well with our earned income proxy, which again relates to getting that payroll employment first thing in the month. Finally, there's industrial production. And that also, the payroll employment data has something called aggregate hours worked in manufacturing. Industrial production is manufacturing plus utilities and mining, et cetera. So it's not a perfect conceptual correlation, but it's close enough because obviously manufacturing production is the majority of industrial production. And what has that been doing? That's been kind of going sideways. So if you're looking for a growth recession or no growth, you'll see it more in industrial production. And again, I think a lot of that has to do with the goods side of the economy. Now, some of you will say, well, how about the leading economic indicators? Those are down. They've been down basically a straight line since February of last year. On average, they tend to call recessions with a 12-month lead time. So we should be experiencing a recession right now, and that's not the case, but there's variability in that lead time. So it's still conceivable we'll have an economy-wide recession in the second half of the year, or now I'm hearing people pushing it into next year. For now, it looks to me as though we're in a rolling recession. It looks to me as though the earnings season turned out to be better than expected. I think the economy is continuing to show its resilience. And now let's have a glance at some of the charts here that are consistent with the story or inconsistent. I try to be balanced when I can be, notwithstanding my bias towards optimism. By the way, speaking of that, some of you may have signed up for John Malden's strategic investment conference. It's been going on for the past several days. It's virtual. I'll be on with Dave Rosenberg. It's going to be sort of I guess it's going to be a bull-bear tug of war between myself and Dave. I know Dave, and he's got his views. I've got my views, and we'll share them with people who call in. So I'm looking forward to it. Now let's go and look at this. Dave isn't the only one thinking there's a recession. I know he just recently said at the conference that there's a 99% chance of a hard landing and a 1% chance of a soft landing. I think he's exaggerating a little bit, but that's my view, 60% chance of a soft landing and 40% chance of a hard landing. In other words, I'm willing to concede that there's certainly a possibility that this thing does not go well. And I would guess right now that the main risk is that this underlying banking crisis, which seems to have calmed down, suddenly emerges as another big issue for the availability of credit. But that's not my most likely scenario right now. And like everybody else, I'm watching the weekly data on commercial bank assets and liabilities, and it looks as though the situation has calmed down, that the Fed has managed by providing basically open-ended liquidity to the banks, basically a discount window that's available for 1 year instead of 3-month kind of lending. It seems to have calmed things down. So there are these measures. You can read about the specifics of them that the Philly Fed puts out by using a survey of economic forecasters. And you can see that these two measures of expectations have shown that there's been a lot of pessimism about a lot of people thinking a recession's coming. It seems to have eased a bit in the first quarter, but still remains quite high. At the end of last year, the consensus of investment strategists, according to I think it was Bank of America's survey, we're looking for 2 down quarters, for 2 down years, for another decline in the what am I looking at here? Sorry, the S&P 500. Yeah, so they were saying there's going to be another decline this year in the S&P 500, and as you can see from this chart, 2 consecutive declines in the S&P 500 is quite unusual. I guess I was looking through my left eye through the aquarium lens there. So figure 4 and 5 are 2 of the most often cited charts by the bears for why they're right and the bulls are wrong. For starters, a lot of these bears have been bearish for quite some time, otherwise known as perma bears. I've been accused of being a perma bull, which I view as a compliment, because the stock market's been up a lot more often than it's been down. But as you can see from this chart, the argument of the bears was that the bull market was just a figment of our imagination, or a figment of all the liquidity provided by the Fed through its quantitative easing programs. And so far, they may be onto something. I mean, they missed the bull market because they dismissed the impact of liquidity. Liquidity is important. It's like, the old story about how many Teamsters does it take to change a light bulb? And the answer is 4. And then the next thing is, do you have a problem with that? So, I mean, I don't know what the problem was for the bears. if they recognized that liquidity was driving the bull market higher and that liquidity was being continued to be provided, they should have been bullish. But we were bullish not just because of liquidity, but also because the economy looked okay, earnings looked okay, margins were improving, and so on. Well, it looks like they may be onto something, because the market peaked on February 3rd of 2022, and that was in anticipation of quantitative tightening, which we can see has started last summer. And sure enough, the market anticipating that took a dive. Of course, there's things like the war in Ukraine. There was the Fed actually raising short-term interest rates in addition to quantitative tightening. But we'll see how this plays out. This would suggest that if the bears are right, that this is going to continue to decline. And so maybe this time the perma bulls or the bulls will be wrong, because they just won't concede that this point. I mean, I guess I should be symmetrical about it, right? If I'm willing to concede, if I'm willing to say and forecast that liquidity is what drove the market up, then I should say that QT drove it down. But again, it may be the psychological defect to have for optimism. But I see lots of reasons why this relationship may not continue to evolve for the bears, anyways. This is another one that the bears point out and say, look at this. This is horrible. You got like -4% on a year-over-year basis for M2. It's never been like that. I think that ignores the fact that we were up like in the 20% year-over-year range back here. Again, the pandemic has had a lot of effect, had an effect here, and this is a kind of a shockwave effect. Let's look at the actual level of M2 and deposits. And if you extrapolate this blue line here, it still looks like we're somewhere between 500 billion and $1 trillion above this trend. So there's still liquidity in the system relative to this kind of really rudimentary trend analysis. This, by the way, is a weekly series that's available in the commercial bank asset liability release that we're monitoring, because the Fed stopped publishing weekly data on M2. So this is a good handy way to see what's unfolding there. And then, of course, there's total deposits, total demand deposits in M2. And what you can see there, again, this is on a ratio scale, so you want to factor that in. But I mean, this looks like something like $2 trillion over the trend. That doesn't necessarily mean it has to come back. I mean, we went over the trend here following the great financial crisis. There seemed to be a preference for liquidity, and demand deposits as a fraction of M2 has actually been going up. So maybe the world's been such a crazy world that people want to have more M2 and more of it in demand deposits. Meanwhile, you can look at this chart and also make a bearish case, because as we can see, the unemployment rate always bottomed right before recession. So if it can't go much lower than this, then the next thing is going to go is up, then that will mark a recession. The only problem is that there's no real compelling evidence in the employment data itself that suggests an imminent recession. We've had some layoffs, and even in the layoff industries, in the April data, we saw some increases in total employment. For example, the information industry. This is another example of the unemployment rate, short-term and long-term unemployment, all showing that the labor market is very strong. Fortunately, the labor force has been increasing. People have been coming back. Again, the pandemic, for various reasons, caused people to drop out of the labor force. Now, some of them may be starting to come back, and that means that if the demand for labor is there, the supply is there, we should be okay. And you can see the participation rate of prime age workers, 25 to 54. I mean, I consider myself prime age, but I'm not in that group. But 25 to 54, they're called prime age. That participation rate has increased substantially. So, you know, the employment measures are all looking pretty hot. Look at this full-time household employment has just kind of skyrocketed here to a record high. It may be that some people who in the past could only get part-time jobs are not getting full-time jobs. That's a possibility, and that's a good thing. Then here's our earned income proxy that I just mentioned before. And this is the red line here. And if you take a magnifying glass to the chart book that we sent you, you can see that there was a 0.7% increase in the earned income proxy. I mean, the earned income proxy doesn't fluctuate very much. And again, it's based on hard data that goes into calculating the wages and salaries in personal income. So this is wages and salaries in personal income. The difference obviously is salaries, but wages are a significant part of wages and salaries in personal income. And that in turn has an impact on the trend of retail sales. It is kind of odd to see retail sales kind of go flat when wages are still going up. But there again, there's that pandemic effect. People bought a lot of goods coming out of the lockdowns and then pivoted to services. And that's where you've got to be empirical about these things and not get too hung up with macro models of what should be. Or at least you got to take your models and make some serious adjustments for what has been and might continue to be the impact of the pandemic shock and the shock waves. So as I mentioned before, I find this kind of fascinating that construction employment in April, all-time record high. Most people wouldn't have figured that out since the headlines are full of how single-family housing is in a recession, but not multifamily, not non-residential manufacturing. Construction of manufacturing plants is at an all-time record high. Again, onshoring and some of this incentives from the government program. Here's another one I mentioned before, truck transportation. If retailers are experiencing a recession, what are trucks hauling here? And so the truck transportation still looks quite good. Retail trade, that's flattened out, consistent with the impact of the pandemic on goods sales. But on the other hand, wholesale trade employment is at an all-time record high. So you can look at some of these more closely in your free time. But this is, I think, the beginning of an encouraging chart. Maybe I'm kind of jumping the gun and I'm seeing things here that I'm imagining. I have been accused of being delusional, but that's what happened. I suspect when bulls and bears get together, they spend a lot of time arguing that the other side is delusional. But in this case, I would point out that there is an indication here that wages are rising faster than prices. That can only happen sustainably if productivity makes a comeback. And that's got to be the big contrary story here, because productivity has been absolutely awful because of the pandemic's impact on all the quits and turnover in the labor markets. Pretty hard to maintain productivity when you got to hire new people that you have to train and then they quit on you. But I think that kind of churn is likely to dissipate. And I think companies are going to be focusing more and more on how to increase the productivity of the labor force they have so they can pay them more in real dollars. And that will reduce the churn in the labor market. Well, let's turn to the questions here and see what we got here. Willem, how do you expect the debt ceiling standoff to play out, and how does this impact your forecast for the U.S. and global economy? Maybe I've been doing this too long and I've become jaded about it. I've seen a few of these things. I remember back in, I think it was 2012, that there was a lot of anxiety about the fiscal cliff. And then right at the very last minute, I think it was actually New Year's Eve, there was a deal done between, get this, Joe Biden and I forget his name, McCullough? Oh, you'll remind me. Anyways, there was a deal struck at the last minute, and I think it will be done again. Okay, Michael, I think you mentioned several briefings ago that if the Fed raised rates in May, you'd become more pessimistic in your outlook. But after they raised 25 basis points, your outlook didn't seem to change. Was it because of the language they had around a potential pause, or did something change in your thinking? Yeah, my thinking has been that if they're going to do that last 25 basis point, in my scenario, it's got to be accompanied by. I think that it would have been better if they used the word pause, but they obviously wanted to leave themselves a lot of flexibility. So I think in effect, Powell left this scenario quite open for pausing, and I think they will pause. And meanwhile, the economic indicators look just fine. You get a copy of the charts. You go to the website, and it's on there under morning briefings. Okay, if the banking crisis is calming down, then why did we see First Republic just go under? The banking crisis, I think, included SVB, it included Signature, and I think it included First Republic. I mean, First Republic was on the ropes essentially at the same time. There was obviously a tremendous amount of a lot of shorting of that stock, and deposits did leave. Both SVB and First Republic in some ways had similar business models of attracting very wealthy individuals, lending them money, making them mortgages, and then asking them to take their deposits from their venture firms and that they used for payroll and deposited with them. And some of the venture capitalists started going around telling everybody to get out of SVB, and then it didn't take very long for the market to look around to say, well, who's got a similar business model? So I kind of view those as the beginning of the banking crisis. And that was basically March 8th, 9th, and 10th. And then on March 12th, which was the, March 12th was the, I'm blanking out here. March 12th was the Fed was, the eye is a little disconcerting. So I'm trying to focus here, work with me. So on March 12th, we had the issue with the Fed coming in, the FDIC coming in and basically providing a tremendous liquidity facility. And so I think that stabilized the situation, but it ain't over until it's over. It could still cause some problems here. But I think the Fed has so much experience with just throwing liquidity at these problems that, and it works. And maybe this one will work too. You may not like it. I don't particularly like to see this kind of, that they got us into this pickle. But it seems to be working, and so I don't think that the banking crisis is going to turn into a economy-wide credit crunch, which then becomes an economy-wide recession. I think at this point that's got to be the most plausible argument that the bears have, the pessimists on the economy have, is that you ain't seen nothing yet, that the banking crisis is going to get worse. That's not my opinion. Let's see, Gus. Let me just make sure I got everybody. Oh, we got a few more. Okay. Gus, Ed, SNAP, SNAP payment benefits are going lower as less people are becoming eligible. How impactful do you believe this will be? I don't think it'll be very impactful. It is a income transfer for the government when people need to eat and need support. Now I think the economy is providing that support through jobs. And so I have no real issue with SNAP being cut back, reflecting the fact that the economy is doing better. Bill, who writes the morning briefing? I do. Quite impressive in terms of the detail. Thank you. Well, I do with an extraordinary team. And you can see the names of all the players at the bottom of the morning briefing. But Bill, I'm glad you like it. Okay, one last question here from Evan. Glad all went well with the eye procedure. Thanks. What are some anticipated impacts from treasuries that mature within the next month or two? Very interesting point you're making there, because securities held by the commercial banks have been declining. The question is, are they selling them because they have to and are absorbing some losses, or is this maturing securities? I think it's mostly maturing securities, and that actually is an important development, because if the banks that are under some duress here get some deposit outflows, but their maturities, enough securities are maturing so they can meet them without actually having to go to the discount window or to the bank, the one-year bank lending facility, then that's a good cushion against a banking crisis. Also, some of them may not be having problems with deposit outflows. They may be having more of their securities mature. They're not renewing them, and instead they're making more loans. I guess the concern might be that from a demand and supply standpoint, if you've got the demand for securities by the Fed, by the commercial banks going down, wouldn't that send bond yields soaring, especially when we've got lots of supply given the deficits? And the answer is demand supply is always kind of a complicated way to look at the bond market because there's a lot of moving parts there. And one of the moving parts that people aren't that aware of is over the past 12 months, I think through January or February, the TICS data that the Treasury puts out shows that foreigners bought $1 trillion worth of government securities, agencies and mortgage-backed securities. So that's been an important offset. Also, a lot of people that have kind of been upset by what they're hearing from the bears and the pessimists have decided to put their money in government securities, and that's created some demand there. So I found historically that the bond market has more to do, the bond yield has more to do with inflation, expected inflation, and how we all expect the Fed to respond to those events than it does to supply and demand. Well, we did it again, kept it to about half an hour. It seems like 31 minutes is the average here, but that's pretty good. We're going to stick to it, and wish you all a great week. See you next week.